Hi, friends. Lee Brickey here, your best source for real estate in Palm Beach County and the Treasure Coast. And today I'm joined by my good friend and lender, Brent Starks from Unitas Lending. And today we're talking about the housing market here in Florida, what's happening right now, what's going on with all this inventory. Also, there are some new programs out right now helping folks purchase homes during this time. And what we want to do is share with you all of this bad news that's on the market, but how you can turn this bad news into a new home for yourself, because we're doing it right now every day. The market's starting to show some wind behind our back. We're seeing buyers come out into the market. And when they do come out in the market to buy a home, they have more inventory than they've ever had to look at. And also, we're able to save them anywhere between 5 and 20% on a home, depending on where that home is right now. But we have been pretty much steady at 15% off of the price of the house on with all of our buyers, and we've seen about the same numbers happening with our sellers right now. So the Florida real estate market is on sale right now, and there's not a lot of people in it. So in this video, Brent and I are going to shake it all out for you, tell you the numbers, show you why this is a good time for you to get out there. If you're looking to buy a home and you don't have one to sell, this is a great time. Don't you think, Brent?
I think it's a great time in that scenario you just laid out. Absolutely. Because right now it is a tough market for sellers, but boy, there's some real bargains out there. And of course, we're seeing the concessions, which are really helping people with these interest rates and buying rates down, which we'll cover today. But yeah, as far as you're exactly right. If you don't have a home to sell and you're looking to purchase now, it's a bargain out there for sure.
Right. So let's show them the numbers, Brent. So here's Florida right now. So pulled this up. Florida home prices declined in May 2025 by 1.7%. It's a pretty good hit.
Yeah, that
And if
is.
you look at it, Tampa Metro, Orlando Metro, Miami Metro, Jacksonville Metro, you can see in the pink there the negative asking price. So we're almost somewhere around 2 to 3%. It looks like on prices dropping in those metro areas. And then you can see how inventory has grown dramatically also in all these areas, and how much people are dropping their prices from the asking price. But here's the thing that everyone needs to understand. So Brent took me out to UWM, United Wholesale Mortgage, which was one of the greatest companies I've ever seen. And it is his main mortgage lender he uses, the largest mortgage company in the United States. And we saw Barry Habib. So we're going to go through some numbers here. And then at the end of this video, I'll have the video with Barry Habib for you to watch. I think it's a good idea. If you disagree with anything that we're saying today, you can go watch Barry. Barry's won 4
Crystal Ball.
Crystal Balls last year. And that's for like 180 different analysts he beat out, 180 analysts on the market. Everybody last year was saying home prices would drop. Barry said prices would go up 4.5 to 5%, and they did. So these are pretty much numbers that, if everything remains the same, we're going to see this happen over the next couple of years here. So let's go through the demographics right now, because we hear a lot about people saying, Brent, that the market's going to crash, right? Mm-hmm. Now we've been hearing a lot of recession fears that just went away, but tell people real quick on that one, how recessions work with home prices.
Yeah,
because they think if we roll into there was an article written by Zillow, of all people and of all big companies, and they said if we go into a recession, home prices will go down. No. But that's never happened in history, Brent.
No. There's one time, that everyone goes back and refers, because it's not that far back for a lot of people. They remember the 2008, 2009 crash. And what that was basically there were a tremendous number of bad loans out there that were stated income. There was no income qualification at all. You were seeing people put 0 down with a 580 FICO score, which is a low credit score. So people with bad credit stating their income, no qualifying, and they were putting zero down. That's just a recipe for disaster. And so that's what caused the crash of 2008, 2009. And a lot of times people refer to that, well, recessions cause prices to drop. And that case is the only case there was where that did happen. But it didn't have anything to do with the economy. It had everything to do with bad loans. And
Right.
so, once that started, it started a contagion. And then it was like, well, it won't go into the paper market. But when so much property, to give you an idea, 47% of loans in 2006 in California, where I was originating loans at that time, 47% were stated income. Now, imagine this. No one had to say how much they were making. Actually, they did say how
Right.
much they
Oh,
were
I
making.
remember it. Here,
Remember
here,
that?
just here, put your income down and sign this. That's
Right,
literally what it was.
right.
The guy that was mowing my lawn owned 7 houses.
Exactly. We saw that all the time.
Right.
Exactly the same scenario. I had somebody purchase a $750,000 home. He was mowing lawns for a living for someone else, making $2,500 a month, and his wife was cleaning hotel rooms. And they started with a 1.9% start rate. It should have been criminal at that time, but they were doing these types of loans, and they adjusted to 7.9% the next month. It was just so out of control. But they packaged these loans up and sold them, and the bond
Right.
rating agency companies were rating the day paper. It was crazy. It's
Right.
like this can't be. And so you could
Right.
see it kind of coming, right? And so that
Right.
is a very much a one-off. But every other recession, like you said, Lee, prices actually tend to go up during
Right.
recession.
Because mortgage rates go down, right, Brent?
Hundred
Because
percent,
people bail out of the stock market into bonds,
right?
and the bond prices go up,
Yep.
and mortgage
Yields
rates
go
come
down.
down. When the yield goes up, the mortgage it goes down.
That's
Right.
correct. There's an inverse relationship. That's exactly
Right.
right, Lee. And so that's what I see happening now is things, the economy slow down and these job reports, another one just came out. It's just crazy. They're always revised downward, that's like delaying the bad news, and so, yeah, so we're kind of in a situation where we're seeing
Well,
interest
that's
rates drop.
another thing. I think people are seeing that too. So, before we get into this, I wasn't going to talk about this now, but I will. That's a consumer confidence thing.
Right.
And so if you tell me if you say, hey, Lee, there's 3 things that make the market right now stall, I would tell you that would be uh, jobs, right? Because we're
Right.
seeing the unemployment rate go through the roof right now. I
Right.
mean, they put
Real
out these
unemployment
jobs numbers, but they revise them. They revised them by 50,000 jobs last 2 months.
every
So,
month. Yeah.
yeah.
At
And so
least.
I'm talking to
Right.
people here in Florida that have high paying jobs, right?
Right.
That had high paying jobs, and they're trying to find a job. And this is in the nursing field, right? They're trying to find a job right now, and they can't get a job making as much money as they made before.
Right.
Right?
Right.
There's
That's
just
what we're
not a
seeing
lot
all
of
the
jobs.
time.
There's not a lot of good paying jobs out there. There's jobs, but they're saying there's 14 million jobs. You look at the job numbers. There's no way there's 14 million jobs out there right now.
No.
So I think the Fed's way off on that, and I think that's going to cause problems. And again, that's another thing that you can go look at the last video and the way Barry explains it,
Yeah.
because you just have to look at the numbers.
You do, Lee. The BLS, the Bureau of Labor Statistics, that's the federal government's report that's been revised down every month. The following, the previous month gets revised down. And it used to be the number one way to anticipate jobs. Now, ADP, which usually was a low impact report, it's a payroll company. Now, the investors are actually weighing that higher than the BLS report.
Right.
That's how bad it's getting. And the the numbers are just horrible for ADP. It's showing 32,000 new jobs. To give you some scope, as a nation, we need to add 175,000 jobs per month just to keep up with population growth. That's, in other words, the birth death rate, if you will. So we need that just to keep up with pace. And so that's like a break even number. And we're substantially, if you look at the ADP report, it's not anywhere near that, not anywhere near it. So,
Right. And if you think about it, like, so it, I think the winds that are back right now with mortgages, right? If the Fed continues to ignore the job numbers, right, and just keeps looking at the economy, which gas prices here in Florida are below $3 now. We're seeing egg prices now in the paid $4.50 for eggs. Now I was at Costco. I don't know how much they are in the grocery store. I don't, but whatever, $5. So they were $8, right? Something like
right.
that. We're seeing inflation though start to taper down. We're moving away from inflation. We're sitting at 2.1% right now.
Right.
So
Roughly.
yeah, so 2% we were at, 1.8%, 4 years ago. So we're seeing inflation start to move down. If the Fed continues to ignore the job numbers, we could see a recession just over jobs.
Right. Right.
Because
And
it takes 6 months for the rate cut to kick in and affect the economy.
right.
But
And
mortgages are different than that, and because they're connected to the bond.
yeah.
And there's all kinds of stuff going on right now with the Treasury Department, uh, trying to unlock the housing market by moving all of the treasuries away from the bond. We can talk about that later, but there's a
Yeah.
lot going on right now to bring rates down without the Fed cutting rates. But if the Fed doesn't cut rates, it's going to put us in a recession. Puts us in a recession, housing market goes up again because
And that'll cut rates.
rates will be cut very quickly then, and then
Yeah.
we'll see the boom happen very quickly. So it's going to happen one way or the other. Rates are going to come down over the next couple of years, or they're going to come down because of naturally, or they're just going to come down as a recession.
Absolutely. Well,
It's
EU's already cut rates, what, 7, 8 times? It's crazy.
Right.
I mean, I
Right.
think we're behind the curve right now.
I think so too.
You think so
I
too? Yeah.
I think so too. I mean, if you look at what's going on, you say it's going to take 6 months. Why hasn't he made a rate cut yet? So
I
that's
think we
my
have
opinion.
2 or 3 are baked in right now, and I think
Right.
that's going to happen. We'll talk about that a little bit.
Right. Okay. So let's get into this screen. Sorry, folks. We kind of got off.
Got off.
We thought that was important to explain to you some things that
Right.
are going on right now. And listen, I want you to understand, this is all about real estate. This is all about you folks buying homes, being successful buying homes, the real estate market, cutting this inflation so we can all go back to our lives the way they were, and pay our credit card debts down and get our businesses moving and our job and find good jobs. So that's what we're concerned about on this channel. But we want you to understand the numbers, because a lot of people are looking at this housing market, and I'm seeing stuff all the time. Like I saw something the other day. It was on TikTok or Instagram or something. One of my buddies sent it to me. Highest, more real estate out there in history right now, right on the market. Markets more real estate for sale in history, and they had like a number of 698,000. Well, number one, the number is 1.7 million, and it's still below 2018 pre-COVID. So you're seeing a lot of stuff. So we want to break down the craziness that you're seeing, and that's what we've been trying to talk to on this channel for the last few weeks here. Is get some numbers to back up the things that you're talking about. Another thing is, you can go on to Chat GPT and put any of this information into Chat GPT that we're telling you about right now. And you're going to see it for what it is. Chat GPT is going to tell you what we're talking about, because we use a lot to make a lot of these graphs and things. So anyways, back to this screen. So this screen shows boomers, Gen X, millennials, and Gen Z in the housing market today. So demographics is destiny, right? So these are the demographics of boomers. So current age of boomers, 60 to 78, population 71 million. Current home ownership right now is 74%. Home ownership when they were 30 was 48%, and home ownership rate when they were 40 was 65%, right? Now, obviously, some are going into nursing homes now. Some are passing away. Some are moving in with their kids. Some are moving around the country because they have grandkids and so forth. So we're seeing, some of these homes starting to come available in the market, but it's not enough.
Right.
And then if we look at Gen X, which is us, Brent, 44 to 59, population 65 million, current homes ownership 65%, so a little lower, right? Home ownership when we were 30 was 42%. Home ownership rate when we were 40 was 59%. So when we look at millennials, that's 28 to 43. So that's our kids, right? Our older kids, right? And then we have daughters that are in Gen Z. But the millennial population, that's 73 million. Now, the largest population of people were boomers.
Right.
Right. So the millennial population is higher than the boomer population. And right now they own 45% of homes. I think right now, what is it, $1.7 trillion in equity sitting in homes right now?
Right, exactly.
That's the
Tremendous.
number, right? Right.
Yes,
So
tremendous.
there's a tremendous amount of equity out there too.
Hmm.
65%. That's if that's why we're talking to you right now, because a lot of people are talking about renting right now, and the market's on sale. And look at these numbers,
Right.
right? So 65%, um, because they've got equity. All these people have equity. If you're in this current home ownership rate right now, more than likely, if you bought your home 5 years ago, you've got equity. If you bought your home 3 years ago, you might be upside down, underwater right now, or you might be right at what it's worth. But that equity is going to come back. I'm sure of it,
Yeah.
eventually, because it always does. So,
Always.
anyways, so 45% of millennials, uh, home ownership rate. When they were 30, it was 33%. When they were 40, it was 55%, right? So
Hmm.
let's look at that. 45% right now, right? Then, so 773 million homes, right? Millennials with the age of 30 to 40, homeowner rate is 33%. Next 10 years, homeowner rates should rise from 33% to 55%, or 8.5 million more homes.
Right.
Right? That's 8.5% million more homeowners. If we just look at these graphs, right? And look at the past.
Right.
Then Gen Z, right? Right now, current home ownership's 8%, right? But when Gen Z, in the next 10 years, that 8% should increase to 33% or 25%, or 17 million more homeowners, right?
Right.
So we need 17 million more homes, folks, right? Over the next 10 years.
These are
So,
household formations. Yeah. So you
yeah,
see it
these are
labeled there.
household formations, right?
Right. Right.
17 million, that's the average, right?
Right.
So since 2020, COVID, those graphs, you see all these, this right here, this is COVID, right? All right. Then after COVID, look at this graph and look at the graph before, right? So demand has been 1.9%, the 1.9 million, right? It's been consistent, right? Since 2020, it's been consistent.
Right.
Supply has been consistent at about 1.4 million. If we need 17 million homes, but then we look at inventory, right? We're 25% less inventory nationwide from 2019. So we still have a long ways to go to reach that inventory. And I'd say inventory when this is 2024, obviously, right? July. So we're inventory is still way down than pre-COVID. Now, before COVID, right? A home here in Florida, Brent, was selling, a beautiful home would be gone in 30 days. If it was really nice, it had multiple offers against it.
Right.
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 I mean, we saw stuff like in just flying off the shelves before COVID hit. We were still low in inventory here. So even if we get
Migration
back
pattern here.
the
Yeah.
migration pattern, right? So,
Yeah.
and then you hear that the people are stopping moving to Florida, right? They're moving out of Florida. And that's true. There are a lot of people moving out of Florida. We're seeing a couple of things happen with this inventory. People are moving out of Florida because the taxes have gotten very expensive here, right? And homes have gotten expensive. So they're moving to places where homes are less money. But those places, homes are starting to go up, like the Carolinas and Georgia and things like that, places like that.
And to
So, because
specify
everybody's
real,
moving to the same place. It's
yeah,
funny.
and to specify, to be specific, the real estate tax is what you're referring to, Lee, not
Right.
income tax. 'Cause there
Real
is no
estate
income tax.
taxes. Yeah. The
There's
real
no
estate
income tax.
taxes.
But the
Right.
homeowner's insurance too is another aspect.
Homeowners insurance too. And that's the entire coast, though. That's
Right.
all coastal properties have high insurance now. So folks that think it's just Florida, you can't get insurance in California right now because of the fires. So insurance is a huge problem everywhere, but the property taxes have gone up every year, especially for people that even were homestead, it's 3% a year. So taxes have gotten high. And that's why the governor right now is working on getting property tax removed out of Florida, so we don't have it
Oh,
anymore,
what would
which would
happen if
be,
that happened, Lee? What would
yeah,
happen?
I know. Yeah, it's going to be incredible to
It would be a
watch
land
that.
rush. It would.
Land rush, yeah, yeah.
Is what it'd be.
They're going to have to wrap some things around that to like protect it a little bit, but
Right. Right.
maybe it moves from 6 months to a year. I mean, there's a whole host of things that can happen with that, but getting rid of property tax for people that have been here for 20 years and retirees would be absolutely fantastic for
It
them.
would be.
I mean,
Yeah.
it would be just great because they have nowhere to move when they sell their house. So,
Right.
anyway, so getting out of that. So we're also seeing though a lot of investors putting their houses on the market because they can't carry it anymore and make money because the taxes are too high. And we're seeing a lot of apartment buildings going up, and the apartments are less than the homes are. So folks are taking the apartments, they're brand new, they have all the amenities in them. A lot of apartment buildings being built right now.
Yeah. 3 or 4 years
So,
of inflation that was just out of control has put a lot
right.
of people where it's about affordability, frankly.
And
Yeah.
I would say too, if this property tax thing goes through, um, you're going to see more homes come on the market. I think by investors are going to start
Hmm.
selling off inventory.
Hmm.
And unless it's Airbnb, I don't see it.
Hmm.
And then that's even kind of starting to. Airbnb's not doing well right now.
Right.
And I don't know.
That's changed.
We'll see what happens. But these are the numbers, right?
Hmm.
So national. So the inventory's up. Home prices are continue to go up also, right? And then we're at what, 7% right now?
Right. Right around 7. Yeah.
Right. So talk about why this is the target, Brent, for the end of the year.
Yeah. Well, there's a few moving parts here, but generally
And by the way,
speaking.
folks, we're looking at the 10-year treasury, the spread between the
Mm,
treasury and the 30-year fixed rate mortgage. Uh,
right.
so Brent's going to explain to you why that this is the target for low sixes by the end of the year.
Yeah. Yeah. So right now, the 10-year treasury as this is being recorded is in the mid fives, figure 4.5, let's say, just grab a number, changes constantly throughout the day. Just to give you an idea. And the typical spread between a 10-year treasury and a 30-year mortgage is about 2.25%. And what that does, it's a risk premium. In other words, if you're borrowing directly or the government's directly borrowing from you and you're buying a 10-year treasury bill, $100,000 increments, and you want to invest it, you're getting about $4,500 on a $100,000 investment, if you will. And the risk of a mortgage, they put about 2.25% risk premium on that because a mortgage is more risky than borrowing or the government borrowing from you. And so, in the event of a foreclosure, you have to go through that process, that type of thing. They put 2.25% in there. Roughly, and that changes, but that's what it's settling in, which is normal. That's a normal spread. And right now at 4.5, when on the 10-year treasury, and you add 2.25 for that, it puts right where rates are right now, 6.75. So you're right in there. Now we know that the Fed's going to cut the discount rate. In other words, the rate that banks, the Fed funds rate rather, that the Federal Reserve, you borrow directly from the Federal Reserve, the banks
Right.
do, participating banks, to reconcile overnight funds. And that's basically its short term overnight funds rate, is basically what it is. But it really sets the tone for interest rates generally because that trickles through the entire banking system. So if you put those cuts in, you're looking at between 3.6 and 3.8. If you put 2 or 3 cuts that are anticipated over the course of the next 8 to 12 months, and when that happens, and you add that 2.25 spread in there, that puts interest rates in the low sixes, high fives. If we get to 3.6 on the 10-year treasury, that would put us at about 5.85 on a 30-year fixed mortgage, somewhere towards the end of this year, early next year, in the event it hits 3.6. And I think it's going to float in that range between 3.6 and 3.8. You'll have up days and down days, and up weeks and down weeks, but the range is going to be right around the six handle, which would definitely impact the market. And I believe as soon as and Lee, you and I have talked about this, if we start talking anything that begins with a 5 on interest rates,
Right.
it'll really set the market on fire. So
I
So
agree.
that's kind of what we're thinking as far as where we kind of know the direction of rates. And I think, there's a study done or a survey, and I think it was 46% of people thought rates were going to go up. And I just, if it's pretty much common knowledge that, the Fed's going to be on cutting rates and the Treasury is going to go down in yield. And we know the spread, but the spread is normally between the two. And so this can be predicted with, a great deal of accuracy. So we pretty much, in anything, no one has a crystal ball, but
Well,
it's
this
just
is like everything remains the same. Nothing
right,
stupid, crazy happens, right?
right, right,
Tariff deals get worked out. Like they get the tariff deals worked out. They get, you know, we inflation keeps like slowing, and we see prices keep coming down. Oil prices keep
right.
coming down. Gas prices come. Gas prices are huge for people right now. I
Hmm.
mean, we see gas prices start hitting low twos. People are going to see a lot more money in their pocket because that's a tax that just really impacts you. We see food prices coming down. That's going to be a big deal. So,
Yeah, it helps the
I
middle
think
class. It doesn't.
well,
It doesn't impact the extremely wealthy. They don't care if
no,
gas is ten
no, they
dollars.
don't care either way.
But
No.
for the guy that's working 40 hours a week, his wife's a nurse and stuff, it impacts that family's budget tremendously. If everyone's commuting, and if we
Well,
have four.
that's why we have the highest credit card debt we've ever seen in history.
That's
It's
right.
over.
Gosh,
Yeah, I
one
mean,
it's over 1.15, 1.17. That was cut a
right,
couple months ago. Almost
right,
almost 1.2. Trillion. Trillion.
right,
And
right.
a trillion. It's a
I
million.
know,
A
I know, it's a
trillion.
lot of money.
Millions
Yeah,
of million dollars a million times. It's crazy.
right. I know. So,
Yeah.
all right, so let's move on. All right, so I'm going to sum this up for you. Markets on sale. We're seeing it every day, right?
Yeah.
Um, Inventory is continuing to go up right now, but we're seeing more inflation start to cool, right? We're also seeing job market starting to cool, right? So that means rate cuts are coming. Uh, the Treasury Department's doing everything they can to sell around the 10-year Treasury so that we don't see the Treasury jump, right? So
Right.
the more short term bonds they sell, the less it affects the 10-year Treasury. So we're seeing that happen. We see that mortgage rates are working down. So I believe, and just from being out in the market, that what we're seeing is sellers having to take these big chops off of what their homes are actually worth. And Brent, I want you to lean into this before we start talking about the homes are really worth. We just closed on them. The client put 10% down on a conventional loan, right?
Hmm.
And got a appraisal waiver.
Right.
The house was a $700,000 house. It appraised at a 700 grand,
Hmm.
and that was the appraisal on it,
Right.
and they bought it for 610,
Right.
right? So explain that to get that appraisal waiver at 10% down, what that means. Like there's no arguing that house was worth what it is because
Right.
the bank that's given the mortgage says this is what it's worth.
Yeah, we have something called an AVM. It's an automated valuation model, is what it stands for. And so it's automated. It's a computerized program that looks at what homes are selling for in an area. And the information now is so much better than it was just a year ago. And so with a great deal of accuracy, they can predict what a home's worth without even doing an appraisal. So in this, you knocked that one out of the park, Lee. I really took to the seller to the woodshed on that one because
Right. Well, I mean, we did one in we got one 300,000 off over $1 million home in PJ National,
yeah.
right down the street from me.
Yep.
780 on a $1 million house, $1.1 million home. I mean, there's
Yeah.
nothing in PJ National for less than $1 million single family. So,
That's exactly
and
right.
that's been that way for a long time. This isn't like this isn't something that, oh well, it's just grown over the last 3 to 5 years. PJ National's always been a great place for equity,
Yeah, absolutely.
and grown. So it's continued to grow.
And
So with all that said, and all of this happening, there are some ways to uh, benefit from this, and we're out here doing it every day. So I want Brent to go through this with you. So Brent, explain this screen to everybody and how this works.
This is actually pretty incredible what's available. So many people don't know this, but Fannie Mae, Freddie Mac, those are government-sponsored enterprises. They used to be privately held. Now the government, it's in conservatorship, so the government essentially owns them, and they're talking about spinning it, making it private again. But it's sponsored by the government, so highly regulated. To long story short, and so they're basically saying, hey, you know what? If we have a seller contribution in a transaction and it's greater than 90% loan to value. And I'll use round figures, Lee. Let's say you're buying a home for $100,000. And so if you're putting 10% down, you have a $90,000 loan. Well, if it's less than 10% down, then the maximum seller contribution can be 3%. That's it. Okay. So in other words, $3,000 can be credited from the seller at closing. It's like cash. So the money the seller is going to get, they can turn right around and give to the buyer to help them with closing costs. Okay. It can be used to
Okay.
buy down the rate, which we'll talk about in just a second. The great strategy we use for one of your clients, Lee. But yeah, so the reason because of the higher the loan to value, the more risk. So they're less apt to allow anything more than 3%. But it gets real interesting at 75 to 90% LTV. Up to 6% can be credited on conventional. Most people don't know that. Everyone always says, "Oh, conventional is 3%." But if they put more down, which a lot of folks are doing as they move down from the Northeast and come to Florida, that credit is available, which is really good, up to 6%. So that when Lee makes an offer for you and asks the seller to give that contribution, that can go right towards all your closing costs. It can help you buy the interest rate down, which we'll talk about in just a minute. But it actually can go up to 9% credit, and most people don't. 5% of loan officers know that, if that. But investment property, it's limited to 2%. As far as on conventional Fannie Mae, Freddie Mac. That's if you're going to rent the property out. Now it gets to government stuff. The FHA, no matter what the LTV is, up to 6% credit from the sellers is allowed to cover closing costs.
And that's loan to value. That's
Loan
the
to
value. That's yeah.
Yeah, so any down payment. So basically, FHA is 3.5% minimum, right?
Right.
So you're putting 3.5% down, and you get a 6% credit from the seller to cover closing costs to use them to buy
Right.
down the rate. You still have to have skin in the game, 3.5%, but even that can be 100% gift. So some great strategies for first-time home buyers. VA is 4%. It's kind of a unique one. No matter what the loan to value is, in other words, no matter what you put down, and
You don't have a
VA,
down payment
you
though
don't
in
have a
VA.
yeah, unless you want to put it
And
down.
by the way, if you're out there and you're a veteran, you need to be calling Brent if you refinance your house to buy a house because VA benefits are not being used right now. I mean, what is it, like 80% of VA veterans are not using their VA benefits because they don't understand them? Look,
That's right.
people, you went out there and you put your lives on the line for us. You served in our military. You deserve this VA benefit. It is something that the government does for you. You need to use it because you can use it as many times as you want. You can streamline it. So they have a streamline loan on it. So if you finance something now and you're going to refinance down the road, they don't charge. They streamline that refinance. There's no charges on it. We can get you, if you're a VA right now, I guarantee you this. I can get you in a house with little or no money down. And
Mhm.
most of the time, I probably right now can get you in a home with no money down with that 4%. Right.
Remember, we were at the closing table and they got their check back
They got
for
a check back. They got a check back for like a couple of $1,000,
right,
$1,500 or something like that.
right, right.
Yeah.
That was
Look,
I.
look, look, let me tell you something. Let me tell you guys something. And we're gonna talk about this right now. Before we go into other stuff. If you look at tradition, the real estate, the amount of problems in tradition right now for sale, I just sent them to a client. There is a lot of homes resales for sale. And then at the same time, you have builders offering all kinds of incentives, 4.9% interest rates. I mean, you name it, the gamut's out there.
Mhm.
But in some of these communities where there's a lot of new construction or they're newer communities, let's say Avenir, Tradition, what's the community out west? these new communities out west that I really don't do a lot of sales in because I don't go out there, pretty much close to the coast. But uh, some of these
Wilder?
new, no, that it's Palm Beach County West, Loxahatchee.
Mhm.
But Mentos community out there, they're not even building now because they've got so many resales out there. 55 and over communities loaded in resales. We're putting a video out on that next week. We're going to actually go and talk about all the 55 and over communities. Coulter's community right here, Alton, tons of homes in there for sale right now, right? Sitting on the market 100 days, 120 days, 180 days. I mean, it's just crazy. I mean, I've seen homes on the market for over 450 days. I mean, it's just insane. If you're a seller and you're out there and you're leaving your home on the market like that, and you're not willing, you don't need to sell your house and you're not willing to take these hits, you need to take your house off the market. I mean, we're not taking listings right now because we don't, that people don't have to sell because we don't use lot boxes. So when you see all this inventory sitting out there, a lot of these real estate agents, they're not showing the house. They're just putting a lockbox on it. So the thing is where I'm going at. Let's just take a community like Tradition,
Can I
right?
stop you just for a second, Lee?
Yeah,
Everyone listen to what Lee just said. He's looking out for you. I mean, you will not find a realtor that says we're not taking listings right now. You just won't. I mean, we believe this data. We're looking forward. We're looking to who we can help and really take advantage of where the market is right now. And if you're not in a rush to sell, he's saying, and like basically, if you don't have a home to sell, you should be buying right now. And
right.
so I just want to point that
If
out.
you have a home to sell and you live in this market, you're not buying a new home unless you're taking it doesn't make any sense for you because
Right.
you're going to take a hit on one side and they're going to take a hit on the other side. You're not really gaining anything, and you could take a bigger hit depending on where your home is than the one you're buying, because the one you're buying might be in a different community. And this is really community driven. I mean, if you go to Miami and you look at these communities, I mean, like, Cool Gables, you can't keep a house on the market and whatever, the Pine, whatever is over there. Those houses are 3, 5, 10, 20, $30 million. They're selling like crazy. And then you go to regular markets and it's dead. There's tons of inventory. Like you look at the number. I mean, we showed it where Miami was on that list, but I can tell you the high end real estate there is moving like crazy. Same as Manalapan, same with Palm Beach. But normal people like buying anything from 300,000 to a 5 million. I mean, I would say that's kind of a normal person here in Florida because everything in Palm Beach County really is over $1 million. Right. And those homes there's no market in. There's nobody moving in it. So there's no reason to put your house on the market unless you have to sell it. But going back to my point, if I could go into Tradition with 20 clients right now, I could bring the market down 10%, 15%. Easy. Like the whole market, bring it down. Because that would happen if everybody came in and bought. But what's happening in this market, because it's something we've never seen before, Brent, and it's confusing to me that it could be this way, but Jay Powell did this, man. I'm just going to say it straight up. I mean, he's responsible for 9% inflation. He was the Federal Reserve, and he watched inflation go from 1.8% to 9%, and said it was transitory. So, I'm sorry. So everybody out there right now, if you can't afford to buy a house, it's Jay Powell's fault. If you're in debt, it's Jay Powell's fault. If you're in food, it's Jay Powell's fault. I'm sorry, it is. It's Jay Powell's fault. I'm just being honest with everybody. I mean, and so
now he's terrified of making the same mistake.
Right, he's terrified of making the same mistake, and he's an attorney. He's not an economist, so he's not reading the numbers right. And there's 2, 3 more attorneys in there too, and they're not economists. I don't know. I don't think economists should be running our Fed, not an attorney. But that I regress. But anyways, I could bring the market down, but that's not happening, folks. It's not happening. No one's out here buying because of, and I believe it's consumer confidence. So the 3 things we're talking about: rates, right? 1, consumer confidence. Number 2, debt. Middle class has a tremendous amount of debt, but consumer confidence is the big one, because we were selling homes last year. and rates were 6.5%, 7%.
Right.
They were 8% at one time.
Right.
And we were still selling homes, right? But right now, homes are not selling. They're just here and there moving. And I believe it's the media and what people are reading. And that's why I bring up the misinformation of 695,000 homes on the market, the highest we've ever seen. And they can't even get that number right. It's 1.7 million.
Right.
All right. So the reality is that there's opportunity here for buyers, especially first-time buyers, especially VA buyers, or buyers coming from another state like New Jersey, where you're going to sell your house in a week and then come down here and just clean up on buying a new home. And you're buying right now, folks, so far under what the house is worth that there's no way you're losing money. So if you're sitting there timing the market and timing when I'm going to buy, right, or when rates are going to come down, you don't need to worry about that. Rates are going to come down. There are programs we're about to go over with you that will get rates down. But on the other side of that, housing prices are going to go back up. Right. We're 17 million homes short. Housing prices have to go back up. How fast did housing prices come back after 2008? How fast did housing prices go up after COVID? Right? Now, part of that was Jay Powell. But rates come back down. We're 17 million homes short, right? It's Florida. This, by the way, DeSantis gets this deal done, folks. This deal done. He gets this tax deal done. I'm telling you, in 4 years, it's the most expensive real estate in the United States because there'll be no property tax. Because what's here right now, that's what people have to understand. Yeah, there's people moving out of Florida. Sure, there's people moving out of Florida. People move out of every state, right? It's expensive to live here. But here's the problem. More companies are moving into Florida than ever have. And they're high-paying jobs, aerospace, brokerages, crypto, tech, all these, and then every company that needs to come in to support these companies are moving into Florida right now, and it's creating high income jobs. And so as the economy starts to turn and these companies start doing better, they're going to start hiring more people. And if DeSantis does this tax thing, everyone's going to want to move here and get homestead exemption. Now, that's what's going to happen, because where are you going to live in the United States and not have property tax? And hey, I understand that some people are really getting straddled with this insurance thing. But you know, if your insurance is $5,000 a year, but your property tax is 10 on a $450,000 house, 12 in Port St. Lucie, you know what I mean? It's like 2.2%.
Yeah.
You cut that and all that's left is a CDD bond.
Yeah.
I mean, Steve, who works with me, he's got a pension. He was a teacher. He was, a school administrator, right? In Baltimore, outside of Baltimore. He's got his pension. He lives on a pension. If you cut the taxes, he brings in another, just 50%. He makes $450 a month. That's a car payment. So if they just cut it on middle class by 50% and give retirees no taxes and do something, I guess, for, I don't know, they might not do anything for multi-million-dollar homes. I mean, they can afford it. I mean, just pay your taxes. Help the people that can't, right?
Yeah.
I mean, that's kind of the road he's on right now. I mean, really, I got to tell you.
What if people do those savings? They're going to spend it on other things too, right?
Right.
It's going to spur on the economy. It's going to be about effective management of our assets and resources.
Right.
And that's what we're talking about.
So if all this happens next year, now over the next 3 years, this real estate market explodes again. And you're sitting on a bunch of equity now, right? You're in a really good spot. So plus, one of the big things that happened during COVID is everybody's out trying to buy a house because it's 2.5% rates, right?
Right.
3.5%, 4% rates, right? So everybody's out trying to buy a house at 3.5%, 2.5%, 3.5%. And then there's no inventory. And then before COVID, we're in the really nice stuff, especially a pool home, because pools are expensive, man. They've been expensive for 10 years. This is a pool ain't God. Pool's been super expensive for 10 years, right?
Right. Right.
So a pool home would go immediately because the pool only got a 20% of what it's worth on the appraisal. So you
Right.
could literally buy a pool for cheaper on the resale than you could buy it on
Yeah.
a brand new, getting a new
It's
pool
true.
put in. Well, so those you put a pool home on the market, be gone in a week or two.
Right.
Like this was 11 years ago, 12 years ago when I started doing retail, right? I mean, it was craziness. And we started doing retail because there's no more money in flipping houses. You couldn't make a dime. It was just got too tight.
Mhm.
So the thing I'm trying to say to folks is this: we're never going to find a time where we can help you purchase a home, or you can go purchase a home from anyone and 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 get a price so far below what the house is really worth. Because our clients that we just put under contract, they're moving up to Orlando, Brent,
Mhm.
and I've sent them to you. They got to buy a house
Sure.
up there. What did I tell them? I mean, I'm not their agent up there. I don't have an agent up there. I didn't refer them. They have an agent, right?
Mhm.
But I told him, I said, look, you got to go up there and buy a house right away. Don't rent, because you need to
Right.
claw back the equity you lost. Because he can
Right.
go up there and claw back that $30,000 that he's upside down,
Absolutely can.
right?
Mhm. Yeah. When
Because you
rates
just
turn around,
sold
you
a
get it back.
$710,000 home would cost you to build, that's only 2 years old, for $100,000 less than you could build it for.
Mhm. Right.
Now it's a resale. So, and it was immaculate. And you can go look at the one on my YouTube video right now. The walkthrough, I have it up there. It's priced at $630 on the video. That
Mhm.
house just went under contract, and we're closing at the end of the month. But the thing is that
Wow.
I just want to. I don't mean to go off here, but I want people to understand
Important.
that I quit listening to crazy people. Quit
Mhm.
listening to the media. They
Mhm.
don't know what they're talking. They crapped all over the real estate industry. Yes, last year prices went up.
Mhm.
They're crapping
Mhm.
all over it right now,
Right.
right? Don't I'm not telling you not to believe your lying eyes, because look, there's a lot of inventory out there,
Yeah.
but it's not as much as it was. It's just not moving like it was. So
Mhm.
let's go into this, because listen, you don't need to pay 7% right now to get into a
No.
house. And that's what we're
No.
talking about. We want to show you how to
No.
get into a home with a buy down, because right
Right.
now there's something called seller credit. And I'm going to tell you this, guys. There's a lot of real estate agents out there, and I'm not bragging about myself, but they know nothing about this.
Yeah. Right.
I mean, so if you talk to your real estate agent and they don't know what a buy down is, you need to find a new one. So
Mhm.
that's a
Mhm.
good check. Hey, what's these buy downs? The
Mhm.
real estate agent says, well, I don't know. Let me check. I'll call my mortgage broker. Oh, don't worry about that. I'm not interested. Just go find a new real estate agent, because you're not with somebody that's going to be able to help you the way that you need help in this market. So let's talk about the buy downs, Brent, and
Sure.
how this can help someone purchase a home in this market and get that mortgage rate down to where it will be eventually over the next couple of years, hopefully, if
Yeah.
everything remains the same. I just want to say that, guys.
Yeah.
Every
Yeah.
It's a
If everything
crazy
goes great.
world we live in right now,
Yeah.
man.
And it comes out of left
I
field.
mean, dude, it's insanity out there. So everything
Right.
remains the same. This is where we're gonna end. But
Right.
eventually, it's gonna be okay.
Well, history does tend to repeat itself,
Right, it
and
does.
if it doesn't, it echoes. Right? It's what they say.
Right.
You know.
Well,
And
that's
so,
how hedge fund guys. Just so everybody realizes that hedge funds, that the most successful hedge funds like Jamie Dimon ran
right.
or run, these hedge funds, they look at the past to predict the future.
100%. You know who
Right.
else does a
Everybody
great
looks
job?
at history, because history just repeats itself.
Yeah.
It's
Absolutely.
just all you have to tie in is technology. What's technology doing to the
Mhm.
future? That's it. Go ahead,
Yeah,
Brent.
I agree 100%. Yeah, another person does a great job is Ray Dalio. I think you've
Oh
read his
yeah,
book
Ray
too,
Dalio.
Principles and
Oh yeah.
the debt. Christ, he's got some great literature and looking at the future to kind of anticipate. Just to bring up one thing briefly, Lee. You were flipping homes, and you were going in where no one was going in. You were going to Port St. Lucie in
Right.
2007,
Everybody. Well,
2008,
then when I
2009.
started selling homes, people were like, "What are you at Port St. Lucie? It's a stupid place to go." I'm like, "Because it's going to blow up."
You
No,
ran
it's
in
how's
whatever.
it going to blow up? Homes are $175,000 because they're $175,000. That's why it's
Right,
going to blow up, and it's 45 minutes from West Palm Beach, dude.
right,
It's not that hard. I grew up
right,
45 minutes out of Houston, right?
right. Yeah,
My
you've seen
town
it.
I grew up with was a little small town. We had a
Yeah,
little a Conroe. On the outside of Conroe, we had cut and shoot. Cut
yeah,
and shoot where we had 10 acres. I kept all my animals, and my neighborhood, I kept my horse, and across the 45, I-45 was the motocross track.
right,
So, I mean, but I live 45 minutes out of the fourth largest city in the United States. Now
yeah,
that city just engulfs Conroe, and cut and shoots now all communities, and the land we used to own is now houses. So,
right.
so when I saw Port St. Lucie, and it's 45 minutes away, and these people are living here in Florida and they've never had traffic, and all of a sudden you see, oh, wait a minute, homes are growing. They're starting to sell stuff there, and
Right,
you know and they're cheap.
right.
I just felt like people are going to go there,
Yeah. I mean,
and they did.
and that's what Warren Buffett did too. He runs in when everyone's running out. You know what I mean? He
Right.
runs out when everyone's running in. If you're getting stock tips from the bagger at the grocery store, pretty much everyone's in. It's
Yeah.
like
And
it's
then, look,
time
guys,
to get
I've
out.
done tons of business in Palm Beach County. I
Right.
just haven't had enough time to make content for both because the market was crazy and I was doing all my own content.
Right.
Now I've got a little bit of help. And so we're starting to break into Palm Beach County.
That's
Um,
great.
but this is where I've lived for 35 years. I've been in for 36 years now. I've been in Jupiter since I was 21. I'm turning 57 this month.
Yeah.
So I've been here. I've raised my children here. My wife and I lived here. We met here in college. And, you know, so I've seen this state, this area grow like crazy. And
Yeah.
that's why, because you're looking at Port St. Lucie now. And we were just in the car. I was in the car going to farms with one of my buddies, and he's a business partner of mine, another company I have. And he and I were going. I was taking him home, and he's a developer and oil and gas guy. And we got caught up in the traffic heading to Port St. Lucie. And he's like, "Lee, look at this traffic." And I go, "I know, dude. It's every day at 4 o'clock. I mean, it's
Yeah.
just craziness.
It's
They got
crazy.
to widen the road right here at Jupiter, bro. I mean, it's
Hmm.
craziness. But
It's
but the
changing.
traffic going north is real traffic now that people
Hmm.
have to drive in, and they're
Hmm.
building another 20,000 homes behind Tradition off of the
Yeah.
Glades Cutoff Road.
Yeah.
I mean, it's incredible. So
Yeah. It's
if you
going to go.
see these, that's another thing I think folks need to look at too, is look at these builders out there and look at the fact that they're still building.
Right.
If a builder's still building, they have better numbers than
Mhm.
that's their business.
Yeah. They're
So they're
watching.
going to look at all the numbers, they're going to look at everything, and they feel that the market is going to pick up. They
Yeah.
think that the market's going to come back, and that's why they just keep building and they just keep offering all these incentives. Otherwise, they would just stop.
Yeah, the thousands and thousands and thousands of lots that were bought up in Port St. Lucie for what, $26 million in 2007. It's another
Right,
example, of
right.
some, the builders going, they know what's going on. So we got a little off the trail here, but yeah,
Right, I
it's
know.
important. It's important to see here talk about this stuff because it's like the information's there, and we kind of see where things are headed. Like you said, Lee, provided nothing crazy happens, we know where this is going. But let me go through the
Yeah,
comparisons
go
here.
through the thing.
Yeah, so the 1.0 buy down, what that means is the first year the interest rate is bought down by 1%. So if your interest rates are 6.75 today, it'd be 5.75 the first year. So it's the first year it'd be down one, and then it's full boat. 2.1, the first year it's down 2%. So if it's 6.75, the first year would be 4.75, and then the second year would be 1%, 5.75, and then 6.75 third year on forward. 3.21, the first year is down 3% or 3.75. Then then 4.75, then 5.75, and then on year four it goes to 6.75 for the rest of the term. So that's what the different labels mean. And basically, to get an idea of the buy down chart, because that those credits we were talking about, the seller credits, what's allowed for seller concessions at closing, can be used for these buy downs. So we did a 10% down on a $500,000 home at 6.75% interest. The first year, the interest rate would be 5.75. So the principal and interest would be $2,626. Then the full payment would hit year two, or $22,918. The 2-1 buy down, you can see where now. Remember, the full payment is 2,918. So in the 2-1 buy down, you start at $2,347, then 26, and then 29. And then the 3-2-1, you can see you're almost $900 lower on the payment the first year, and then it goes to the 2,347, and then the $2,600, and then the full payment. Now the strategy, if you can see this, if you go to the far right, you'll see the total buy down cost. Well, the percentage of is off of that chart. So you could take the $500,000 and then look at what the allowable concession would be, right? So if you just take, let's say, you've got a $500,000 purchase and it's a VA, you can do 4% or $20,000. So on the 4%, you're almost covering the 3-2-1 entirely. You know,
Right.
So
Right.
it's
On a FHA, you can do what, 6%, right?
6%, right?
So
Yeah,
you can do a 3-2-1 buy down and cover most of your closing costs because you're still sitting on another 10 grand. So you could
yeah,
do a 2-1 buy down easy, which, I mean, in your thought pattern, I mean, you can work with people whichever way that makes them feel more comfortable and how much cash they have. But like they went to a 2-1 buy down in their FHA, they put 3.5% down. We could, if we get 6%, we could cover all their closing costs.
100%, absolutely. And by the
See,
rate down.
here's the way this works, folks. So let's say the house is listed for 500, right? Okay. Or six, let's look at it. Let's say it's the five. Let's say it's listed at five. Let's say let's not look at the list. Let's say the value of the house. So Brent goes to UW, goes into a system, pulls the value, and the bank and the appraisal comes in, and the appraisal on that house is $550,000, right?
Mm-hmm.
And we come in with a $490,000 offer. Okay. They meet us at 500. Let's just use these numbers, right? They meet us at 500, all right? Or 510, right?
Mm-hmm. Right.
We just need 30 grand, right? So we can mark the house up, right? Take the 30 grand in seller credit, pay the closing costs and the buy down, right? Mm-hmm. And then you're only responsible for your 3.5%. If you're in a VA, you can work those numbers out the same way. Right. So you could do a 2-1 buy down, cover the rest of your closing costs with the seller credit, the 4%. You're in a great position. If you're moving out of another state and you're putting down 10 or 20%, you want to keep the mortgage down, right? You're selling a home. You can get the buy down and keep your cash in the bank because the equity is going to come back. Why not take the money that the bank is going to give you?
Right.
So take that buy down. Another thing, Brent, talk a little bit about if someone's sitting on a ton of equity, but they have debt and then they're moving because they're having to walk away from that 2.5%, 3.5% rate.
Mm-hmm.
Right. So you're sitting on a 2.5%, 3.5% rate. Your company says, "Hey, you're moving to Orlando or you're moving to South Florida." Right. Mm-hmm. Right. And you got to buy a new house now. You're going to be in a 7% rate. Mm-hmm. Talk about how they can not take all that money and actually, and if they have debt, reduce their debt totally and actually be in a better position because of the equity in their home.
Absolutely. So we've done that so many times where we take the equity in the home, pay off all their debts, like car loans, student loans, credit cards, everything. So your debt ratio goes way down. And then what you can do too in this market, especially, is get that seller concession and get down to like a 3.75 start rate,
Right.
and then 4.75, and the interest rates are going down. We kind of talked about that earlier, so we kind of know the direction with a great deal of certainty that rates are coming down, right? So
Right.
let's say it's 2-1 buy down, so you're at 4.75, then 5.75, and now you're at 6.75 in year three, but interest rates are in the low fives or whatever they're going to be at that time, right? We know they're going to be lower, so we're actually getting the lower interest rates now before they happen, right? And you're not permanently buying it down, which is much more expensive. So the strategy here is to take the temporary buy down, let the market work for you, catch that wave, and just ride it out. And take the lower interest rate now in this interim period as rates trickle down. So that's kind of the strategy on this.
Right. Right. So
Yep.
I hope everybody gets this. This is a great program. Um, let's move forward. Talk about this, Brent.
Oh, it's good. A heck of a purchase. Home equity conversion
But
mortgage.
hey, before we talk about this,
Yeah.
isn't there a program out there on a 580 purchase price? Just so before we move off of the last screen.
Yeah. 580 FICO score, right? That's what we're
Right.
talking about. Yeah. So,
Right. So UWM just dropped a program, right?
so this is
That's for the whole month of June.
the whole month of June. This is crazy. Okay. So let's say you have a 580 FICO score. Generally, they're called loan level price adjustments, or LLPAs. And what that means is there's an adjustment for lower scores. Frankly, the lenders are saying, hey, you know what? In 580 to 600 score, this loan is riskier for us. We're going to raise the cost of that loan in points, or the rate is going to go up. And so it's basically, you can always pay the cost, which is called loan level pricing adjustment, or just go with a higher rate. So right now, so through June, they're removing all of the LLPAs from their best brokers. So anything that's added to the pricing for a 580 to a 640. So if you're in that range through June, they're waiving all that, and that's that. Just to give you a dollar amount on a 580 score, it's saving you about $7,000-8,000 on a 450 loan amount. So it's substantial, and so you're getting the same rate as the elite borrowers, elite credit scores, as long as we lock by June. I think it's June 30th. And so basically, we're offered this. They don't offer it to everybody, but anyone that has a strong pass through, what we submit closes. They don't have a lot of underwriting touches, no problems, no buybacks, and all those types of things they look at for us. But that's available through June 30th. So definitely great. Thanks for bringing that up, because that is an
Yeah.
incredible program, saving a lot of people money.
Right.
Absolutely.
It's a great program right now. I mean, where are you going to
It
get that? So if and here's the great thing about
is
this.
exclusive.
If you have a 580, a 600, a 650, 680 credit score, you can now get into a home for the same price as someone with a 700. But guess what happens? When you buy a house like this and you're getting into a home, your credit's going to go up, because owning a home shows the credit bureaus that
Right.
you are a stable human being, right? You're
Right.
stable. You have a job.
Right.
You're paying your bills, all those kind of things. So it really helps your credit. So you're gonna, within a year or two, you're gonna have over 700 credit score, because you own a home now,
Right.
and you're not no longer renting. And then you know what? You're gaining equity, even though the equity is not there now. It will be there in the future. I mean, if we showed you the graph, housing prices have continued to go up, and we could go back. We could go back 50 years, guys. I mean,
Mhm.
over 50 years, we've only seen one really terrible time, was 2008 in the Great Recession. That's
Right.
it. I mean, that was 1920s, right? The
Right.
Great Recession, but both were created over trying to, you know, uh, help the housing market.
Right.
So the presidents deregging banks, all the way from Reagan all the way to Clinton, deregging banks, letting them and then also getting rid of the Glass-Steagall Act, which kept the banks and the mortgage companies and insurance companies from commingling money, which Clinton did, and caused the crash. So if you
Right.
think about what I just said to you, the same thing that happened in the Great Depression happened 2008,
Mhm.
because they just repeated what they did. Go look at the history on that.
The history of
Very,
it.
very,
Yeah.
it's very interesting.
It
So
really is.
yeah, all right. So let's go on. So how this works. So listen, let's say you're a retired person.
Mhm.
You want to keep that cash in your bank, right?
Okay.
And or you sell your house up north, you come down here, and you want to buy more home, right?
Right.
Or you're retiring and you want to buy more home,
Mhm.
right? And this is a way to do that. And it's a great way to do that. And we're going to keep bringing this up. Listen, I started using ChatGPT at the beginning of this year. And it's been the greatest thing I've ever done because I don't ask anybody anything anymore. I go to ChatGPT and and then I get my research and then I go dig into the research and find out. Listen, you can go to ChatGPT and put in everything that we did because some of these screens were actually made with ChatGPT.
Right.
And it will give you accurate information on something like a reverse mortgage. And it'll tell you everything about it.
Right.
And then you can call Brent and he'll tell you everything about it. And then you need to go to a class where they tell you everything about it.
Right.
So biggest thing we hear on this right here is the family. Can't have mom and dad do a reverse mortgage. Right. There's nothing left. There's no equity. I can't give my kids anything or the kids don't get anything. Right. So families talk parents out of reverse mortgage and we're dealing with it right now. I'm helping a friend of mine right now put her life back together because she didn't do a reverse mortgage when I told her to. And she's now losing her home because her income dropped and now she's on her Social Security and she can't afford to live in her house anymore. She has enough she would have had enough to live in the house and pay her bills if she didn't have a mortgage.
Right.
Or she could have sold it and downsized.
Right. And done a reverse mortgage on that too.
And done a reverse mortgage on that too.
And never had a mortgage payment. Right.
And never had a mortgage. Gone to a condo where she has nothing to worry about, just the fees. Right. Like a small little, not nothing crazy, but just, something decent in Port St. Lucie. So Brent, go into this because this is a great program. We've used it many, many times and it's a great thing for retirees. And it was created by Reagan.
Yeah, it's a great program, absolutely. And a lot of the reverse mortgages is what they used to be called. They changed it to home equity conversion mortgage because there's so much negative publicity around the words reverse mortgage. And so actually, what happened is the FHA took over the regulation of reverse mortgages or home equity conversion mortgages because they weren't. Seniors weren't being educated. So you actually have to take a class. It's about 45 minutes online and on the phone. So you can actually see and understand fully how the program works. Siblings are invited. Children are invited to sit on that training as well so they can kind of see how it all works. But you're right, Lee, the number one concern is usually the children. They're saying, hey, what about me? There's nothing, my mom's going to give the house to the government type of thing. That's not the case at all. It's basically just like any other mortgage. In other words, it's recorded on the property, but there's just no payment with it. And so
let's just go back to this. Reagan created this in his administration.
Right.
The same reason DeSantis is trying to get rid of property tax on retirees. So retirees could stay in their homes.
100%.
That's what this is. That's can stay in your home. But it also helps now because housing prices have gotten so expensive. So you can buy a home without having to take a small mortgage because you don't have enough cash after the sale of your other home to buy that home. Right. So let's say you sell your home up north for $300,000. You come down here. Obviously, they sell your home up north. You got $300,000 cash. Come down here. You want to buy a 450 house, right? Well, I take that extra money out. You just have to have 60%, right, Brent?
Right, around 60%. Yeah.
So 60, around 6%. You take that 60%. You put that down on a home, right? You pay the taxes every day. If you're in an HOA, you pay the HOA, and that's it. You're done. And if you have a CDD bond, obviously you have to pay that, but that's your tax. That's part of your taxes. But other than that, and then, hey, DeSantis might come in and then get rid of property tax.
Yeah, you're right. Exactly.
Then you just have a CDD bond and insurance.
Well,
you have to keep the house up. But the thing is that, I have so many of my friends in reverse mortgages that are retired who didn't really need to do a reverse mortgage, just wanted to take the money out and put it in stronger investments.
Right.
Yeah, the house is still making equity every year.
Right.
And then, hey, you need a roof, right? Pull the money out of the reverse mortgage. Put the new
That,
roof on. You want to do
that's
an upgrade? Pull the money out of the reverse mortgage. Do an upgrade.
exactly. That's what we're doing. We're doing actually their seconds. HELOC seconds
Right.
too right now, reverse seconds. So that's what we're doing with the woman right now. She, her roof was destroyed in the tornado, and so she's got to get a new roof. And we're going to do a second. While she gains more equity in the home, she gets a little older. And by the way, you have to have, you don't. It doesn't require as much equity if as you get older, because basically it's like a life
A life
actuary
insurance
table.
policy. Yeah.
Yeah, right.
Yeah.
So the older you are, the more you can borrow, because frankly the balance isn't going to go up. Past
Right.
your life, right? So we all have an
Right.
expiration date, and so that's how that's determined. But it's not determined by FICO score, by the way, at all, because there's no payment. They don't care what your credit is. So that's kind of interesting too. And the only thing you have to qualify, you should show that you can pay the taxes and insurance, HOA, and so the income qualifiers are next to nil. So actually, I'd use this because this is an exact scenario we're working with right now. She's 68 years old. The buyer qualifies for about 40 to 50%, 40 to 45% loan to value on a reverse purchase. So with that down payment, at 285, it's a done deal. So
Right.
yeah, and so no monthly payments. She can after 12 months, she can start pulling money out on a line of credit she'll get. So she's saying, "Hey, I'm going to need an air conditioner probably in a couple years. It's 6 years old, 7 years old. Oh no, excuse me, the roof was 6 years old, but it got hit by the tornado, so it's 0
Right.
years. Uh,
Right.
the
Mhm.
the uh, the air conditioner is 17 years old, so that's just any time now she's going to need one of those. So that's just a way of in retirement not worrying about money. She goes, I don't have to qualify for it. I don't have a payment. No, you don't. And so it's a really neat way to help seniors retire with some dignity too, and stay in their home. And that's really what they want to do. They want to stay in their home. That's what they
Right.
do. But here's some
Right.
reasons I love these: preserve cash
Let's
flow.
go back. Let's go back. So age is 68 years old. Buyer
Right.
qualifies for roughly 40 to 45% loan to value,
Hmm.
roughly 60% down, right? No
Right.
monthly principal or interest. The borrower lives in the home, primary resident, property taxes, insurance, HOA fees kept current, home is maintained. These are how, go ahead, go through this one.
Yeah, so it's a way to reverse mortgage to finance the remaining portion of home's cost. So it covers the purchase price, but you have no monthly payments, and that's the hardest thing for seniors to get their head around. What do you mean I don't have a payment? I'm borrowing money. The loan balance grows as opposed to go down, and so that's the only difference. So now one of the things I was talking to this woman about, she insisted, because I don't want it. I said, well, make a payment then. She goes, what do you mean? I said, well, you don't. You can make a payment. You can make the whole payment, and it
Right.
actually will go down. You can pay the interest only. You can pay 1 month and not the next. So you can actually pay it down if you want. So it's a
And you
basically
can refinance it because you're financing at the rate we're at now. So you can
exactly
refinance it too, so that you can get more equity in the house,
right.
and because you can lower the payment.
Yes, but
So if
you
rates are down, let's say rates are down in 3 years, we're back in the fours. Let's say that would happen. You know what I mean?
yeah
It's possible. I mean, I think that's on the list of possibility. We're definitely going to be in the fives.
yeah
So you could refinance it again, and that would create more equity in the house. Plus, as the market goes, it creates more equity. So it's not like you're taking anything away from your kids or your
right.
family. The house still can go to them. They just, they can refinance it, pay off the loan, or sell it
Mhm.
and then pay off the loan. But it's how the most important thing is that a lot of retirees, they retire, and they end up moving in with their kids
Right. That's what I
because they
tell them.
can't afford to pay their mortgage or their taxes, so they move in with their kids. So this
Mhm.
is a way for you to stay in your own home.
Right, with dignity, because a lot of times, this is the way it is. The kids are supplementing them now. It's like, well, I said, you can do it one way or the other. You can continue to send them checks, or you can get a mortgage on their own and stay in their home and be, self
Right.
sufficient, and the equity they've earned over the period of 40 years in their home. So it's a great way to help someone keep their dignity. And I always say, basically, hey, what, you're afraid you're not going to give anything to your kids, just make a payment on it. If you can't, or you don't, or you run into a medical situation, this loan can't be taken away either. By the way,
Right.
I don't know if you've ever had a HELOC get canceled, Lee. No matter what your situation is,
Right. I know.
yeah,
That happened back in. They did it back after 2008. They canceled everybody's HELOCs and their cash
yep.
lines of credit.
So seniors that were, hey, that's my fallback position if I ever need a roof or ever need an air conditioner, all of a sudden it's not there. And so it's actually like an insurance policy too, because it's set in stone. You have that equity line, and it grows as the property's value grows as well. So it's a really, the irony is it's actually an extremely conservative, safe investment long term, or strategy long term for retirement. And so, just it's just something that needs to be, fully understood. And once they go to the class, 99% of the time, I'm like, oh, I get it now. I see what you're saying. We do have options, and this isn't going to cut into anything my kids are going to get. And so, so I encourage the kids to jump on the phone too, so they can kind of hear the whole thing and realize, it's
Well, you're helping mom
yeah,
and dad, or helping mom and dad, or dad, and
yeah,
dad and dad. So I mean, it's one of the, I've seen it happen multiple times. I've got, like I said, I got multiple friends on it. I've also,
yeah.
we've done deals with it, and I haven't had anybody call me up and complain yet.
Right, right, 100%.
Everybody's super happy, and it
Mhm.
goes real nice and smooth.
I'm gonna
And it,
put our house on a reverse mortgage when when I'm like
me too.
75, 80, and
Yeah.
it just helped the cash flow for Jenny,
Right.
and
Right.
statistically she'll live longer than me, and so just that's what we're planning to do. So
Absolutely.
yeah,
Absolutely. All right.
good stuff.
Um, all right. So, I put that in there twice. Okay. All right. So let's close it up. So, um, we went a long time on
We
this,
did.
and then, you know what, guys, I usually will chop these videos down, but I'm not. I'm going to put it up. I hope if you made it to the end of this, you learned a lot. But I want you to know that we put this video together today because we want to help people. We want to help people get homes. And right now it's a really tough time out there, but the market is in really a weird place where prices aren't really coming down. I mean, look, if prices come down 20% across the board, we're
Hmm.
really not looking at that big of a drop. So what I find going on right now is, and Brent does too, is that everybody's trying to time the market. So if you're trying to time the market right now, I don't, and you're buying a home to live in, I can tell you all you have to do is pick up the phone, give me or Brent a call if you're in Palm Beach County or the Treasure Coast. If you're not, I can send you to a great real estate agent anywhere you are. Brent can send you to a great mortgage company. He can do mortgages all over Florida if you're in Florida. But if you don't, if you're in another state, you're looking at this, you know, I'm telling you right now in this state of Florida, I can show you the numbers, and I can take you out on the road, and you can pick out 2 or 3 homes, and one of those homes we're going to get, and you can buy what you want. Pool home. I took a client out the other day, and all they wanted to see is pool homes. We looked at 6 pool homes that
Wow.
were immaculate,
Yeah.
immaculate,
Couldn't
that
find
the
one.
agent was like, just put an offer in. Just put an offer in.
Wow.
Do they like it? Just put an offer in. So that's what we're dealing with right now. And listen, on the listing side, I've got a few sitting out there right now, and I'm on the same thing. If somebody
Yeah.
comes, just please put off. The one we just put under contract, we had no showings for 3 months. We get one showing and sell it. My clients, they have to move.
Hmm.
So that's out there, folks. It is out there for you to get. So Brent and I are here to help. Brent, you can reach out to Brent. His information's in the information section below. My information's in the information section below. Also on the screen, you can reach out to me, Lee Bricky. Love to help you answer any of your questions you might have. If you're looking for real estate anywhere in Palm Beach County or the Treasure Coast, please reach out. Brent, you got anything else to say?
I think it pretty much covers it. We went
All right.
long today, but I think it was good too. It's important.
Yeah. All right.
Very
So
important.
listen, 100, we're going to put it up, and hopefully everybody gets to this part. By the way, if you did get here and you have not subscribed, go ahead and slap that subscribe button, ring that notification bell so you don't miss any of our real estate tips and tours. And you can watch the video that I made on Barry when Brent and I were out in United Wholesale Mortgage, which is the
Fun.
#1 mortgage company in the United States. And I put up the screens, and I do a good overview of Barry's way of predicting the market. And when you see this and you look at the different graphs, you're going to see that in that video, Everything we're telling you here is backed up with lots of of uh, of of research. We're not just sitting here saying, "Oh yeah, well, this is what it's going to be, and this is what should happen," and ooh, and like, wow, we're we don't do that here. We haven't in 3.5 years. We've been doing this channel, and I can tell you, folks, you can go back and look at all of our videos. We're never the ones on here talking craziness because we just look at the facts.
Right.
So, with that being said, be kind to each other, and we'll see you in the next video.